Hello and welcome to another edition of the Business and Banking Dialogue, the bi-weekly show that brings you to the best of topics and the best of people who provide you with topical subject matter from the world of finance. Today, we have a new speaker for you and a relatively new subject on NBFCs. So, ladies and gentlemen, welcome to the show. Good evening, and my name is KK. I'm the moderator for today's show. As you're aware, NBFCs, with their significant contribution to the economy, NBFCs have emerged as an alternative to mainstream banking. I think that's knowledge to everyone. NBFCs have contributed to building India's infrastructure big time. They have also built transportation, employment generation, and wealth creation. They have kept pace with the rapid technology changes and the market environment. They have been successful in filling the gap in credit availability to retail customers in remote and unbanked areas, fueling the growth of entrepreneurial ventures in various parts of the country. You have seen for yourself when so many ventures have come up in the rural side of the economy. With their deep understanding of micro markets, NBFCs have been able to focus on the lower end of the spectrum of the economy, of the population, through product customization. Some of the banks that that have recently come, who have been given the license, you see the spread across in the remote and rural areas. They were all NBFCs at one point of time, but their spread and their collection capabilities are unmatchable. NBFCs have contributed big time. In the $5 trillion economy that we are dreaming about, NBFCs are important players of the Indian financial system. To discuss on the topic of NBFCs playing to win in crisis-hit economy of India, we have with us today a very young entrepreneur, the founder and CEO of ORIGA Leasing, Mr. Shrirang Tambe. Please please join me in welcoming Mr. Shrirang Tambe. Shrirang, good evening to you.
Good evening, KK. Thanks to you.
Yeah, welcome to the show.
And everyone at Banking and Business and Banking Dialogue for the invitation. Thank you.
Thank you very much. So briefly, he is a thought leader of leasing in the MSME and healthcare segment, and India's first ever certified lease and finance professional, which is called CLFP. So, ladies and gentlemen, please note that his career is right in front of you. All about him is in front of you. So, he is the first certified lease and finance professional, which is called the CLFP. CLFP designation is the preeminent credential for equipment leasing and financing professionals throughout the world who have demonstrated competency through testing of knowledge, continuing education, and a commitment to their business practices and dedication in the industry. So he is the first advocate of financial inclusion at the B2b level. So let me repeat that once again to you. He is the first advocate of financial inclusion at B2B level. We all have heard of B2C. So, something that's interesting. He's on the B2B level. His dream is to make equipment leasing one of the preferred choices of B2B customers in India. So, Shrirang, once again, welcome to the show. Shrirang, my first question to you is, so we have heard of financial inclusion and we know of how it works. We have had several speakers talk about financial inclusion and how they are the backbone of the economy, etc. Okay, but we have all restricted ourselves to the B2C side of it. Okay, and when we talk of B2C, it's always small ticket size loans. Okay, explain financial inclusion in the B2B space.
Yeah. NBFCs in India are in the initial years, you had a categorization by RBI into NBFCs. So there were 5 categories that RBI had specified: a loan company, an asset finance company, a hire purchase company, etc. Over the period of time, what has happened is all these lines have blurred because you give somebody money and that can be used for either a personal use or professional use. Within a professional use, you can buy an asset, you can buy a two-wheeler, you can buy an inventory. So over the period of time, the categorization of NBFCs from an end use fund perspective started crossing each other. And because of which, what has happened is today we clearly have two distinctions, which is one is B2C, where you kind of cater to the individuals, and you have a B2B where you cater to enterprises. Now, even within enterprises, there are a lot of NBFCs that say that we do retail business. So people classify retail, within B2B, people say we do retail business and we do a non-retail business depending on the ticket size of the organization, of the loan,
Yeah.
or the disbursement that they do. However, B2B today, according to me, and this is how I think a lot of people do view it and should view it, is helping those smaller enterprises scale up. Whether you are helping them with any of the financial product of lease, loan, including MFI loans for, say, an agri business or a dairy business or whatever. Typically, a B2B should be something where an enterprise which is small, which would have been outside the formal channels of credit or has been struggling to scale up because of lack of credit, you are empowering that enterprise, you're empowering that company, that entity by credit and helping them grow. It could be helping them in their production, capacity, working capital, inventory financing, debtor financing, bill discounting. It could be host of areas that you are catering to. But at the end of the day, you are catering to an enterprise to scale up. So this is where I believe a B2B angle comes into play. Whereas on an individual or a B2C side, you could look at giving loans for individuals to buy home, two-wheeler, etc. But sometimes these lines get, the lines drawn in the sand. So what if there is a sole proprietor?
Yeah.
You give a loan to a sole proprietor. Now, whether you classify that as a retail loan or will you classify that as a B2B loan? So in some cases, these are lines drawn in the sand.
That's fine. That's understandable. Okay, and I mean these kind of boundaries are just imaginary boundaries that can always get blurred. Uh, Tell us, that's interesting. The concept of a B2B financial inclusion, and tell us some experience that you had, and how's that been in your leasing company?
So it was basically the whole idea of B2B financing should be, according to me, enhance productivity. You should
Yeah.
be able to enhance capacity augmentation, capacity expansion, increase the profitability. So I feel that a lot of small and micro enterprises in India have their own poverty cycle. And I define that as a poverty cycle. It's a very harsh word to use, but it because comes stems from an idea of, say, you have very substandard machinery, because of which you have a very substandard output, leading to lesser realization per unit, bad numbers leading to bad credit history leading to bad loans. And again, you're going in for again a substandard capacity, substandard machinery, substandard kind of a production, because you're not getting out of this cycle. So somewhere you need to break a B2B poverty cycle also, where you should augment the capacity of an factory or an enterprise. You should help them get best of the machines. You should help them get best of the resources, best of the manpower. Or can you give them a working capital loan for very quality hiring? Can you give them a credit line on the working capital front so that their inventory and debtors are taken care of? So there are various touch points on that poverty cycle that if you are able to address them, then what you basically do is you uplift a small enterprise into the next level, into the next orbit, whereby the productivity improves, the profitability improves, the realizations or the margins improve, the scope, the canvas widens for them. They are able to target a larger customer. They are able to break the glass ceiling. So according to me, these are the impacts on the ground that one should measure when somebody is giving a credit to an enterprise or in a B2B segment. What is the real impact that you're making on the ground? Everybody will earn an interest. Everybody will earn a processing fee. Everybody will earn an income. I think that is something which is a common factor or a common denominator across all credit providers, right? But one step forward is, how are you going to make an impact on the ground for these enterprises when they avail the credit from you, and which are the boxes that you're taking off where the impact is actually made. And I think that makes the process and the game very interesting.
Excellent. I mean, it's a great idea, Shrirang. So, Shrirang, what is the impact on NBFCs due to the, we have had, I mean, actually we have a double whammy, right? We have the economic collapse, and maybe because of pandemic. And so the pandemic and the economic collapse, what has been the impact on NBFCs?
So I think the single biggest impact on the NBFCs has been painting the entire industry with the same lens of risk and calling the entire industry extremely risky. So everybody will have their own views on the segment, and I think the government and the regulator has done a lot of work in helping the NBFCs. A lot of measures have been announced for liquidity, etc. So I'm not getting into all that because that's all there in the and a lot of discussions and forums have had that. But one of the biggest impacts that I could see is the entire sector, irrespective of understanding who does what, was perceived and is still being perceived to some extent as extremely risky. And I think that is where people will have to change their outlook, especially the investors, the lenders, the capital providers to this segment, where a, a second level and a third level of understanding will need to come into play as to what this NBFC does, what is the business model, what are the risk management, etc., etc., and then take a call. I mean, you can always say no. There's no problem in saying no to someone, but I think painting everybody with the same brush has been the biggest casualty of the sector because of these two hits that we have had.
Okay.
And traditionally, if you see KK,
Yeah.
the last 70, 75 years or whatever, 50 years, whenever the NBFC are there, they've been one of the best paymasters with respect to returning their capital to the banks, or and providers. I mean, you can always have one or two cases of NBFCs going bust, or DHFL kind of an issues, but the same set of issues you even find in banking. So,
Yeah.
but if you see historically, you haven't had 10 NBFCs going bust every year, or 20 NBFCs defaulting every year, and the entire contagion effect. You haven't seen that for last many years. So I think the sudden risk profiling of the segment, saying that it's an extremely risky category because of moratorium, pandemic, is I think little is an overreach according to me.
Yeah, true. I think to some extent I agree with you, because banks are also collapsed and are collapsing, and so some of the NBFCs will become unviable or have some problems. Painting with the same brush, perhaps. Shrirang, as the economy shows early signs of recovery, even today morning, there was this RBI governor's speech on the MPC management, the Monetary Policy Committee. It says that, so he also talked about recovery. He has, he's hinted that there's a silver lining coming up. So as the economy shows early signs of recovery, how can NBFCs drive revenue growth? And I think you can also club and ask, or should NBFCs evolve to maintain market relevance and improve their competitiveness?
Yeah, it's an interesting point. So what has happened is this entire phase, right from ILFS onwards, or even before ILFS, on all the crises that you've been seeing till now, one trend which has emerged is a lot of specialists have emerged in the market, right? You mean specialists, it means NBFC that cater to specialized segments. It could be a market segment, it could be a geography, it could be a product. And what people are realizing now is these specialists have a good control and a hold over the business activity that they do, right from having a touch point with the customer, having the credit underwriting process, collections, technology, distribution network. So if you split a business model of an NBFC into these 4 or 5 buckets of activities, right? Specialists have kind of emerged quite well compared to a large format generalist, which maybe if you could categorize a bank into that. And what has happened is because of this, there has been a deeper understanding of the arena that you're playing in, right? Whether it's an understanding of your profile of your customer or the product or the environment, credit risk, etc. And this is the way I personally believe that the NBFC market will go. And I'm clubbing that with your recovery question. So the recovery of an economy will be fueled by these specialists, and I'll tell you why. Because their understanding of the credit risk, understanding of the risk in the environment that they play will be high. So their ability to take risk and ability to fuel capital into their particular segment will be high, because of which as soon as they see green shoots, or as soon as they see positive trends, their ability to push capital into the target segment of their customers would be significantly higher compared to people who are viewing all segments with the same box. So the heterogeneous market of or the characteristics of the customers or the segments or the products being heterogeneous will actually play to the to the strength of an NBFC, because they would be able to revive, they would be able to contribute in the revival of the economy in a far better manner, because they exactly know where the risk lies and they exactly know where the opportunity lies, right? And they have built their processes, systems, their technology, their manpower in that manner. So these product specialists and this category specialist would, I believe, they would be the key catalyst for economic growth in the coming months or in the coming quarters. Like for example, the way we see it, right? I mean, at ORIGA, we have been super specialist at equipment, especially the MSME equipment and the healthcare equipment. And over the last 2 quarters, when in the peak of this pandemic, our collection efficiency has been higher than most of the average industry that any of the rating agencies have been quoting, right? We've not had a single NPA or not a single equipment coming back to us. And the reason being, uh, the way we understood a customer while underwriting, the way we understood the importance of the machinery that we gave to that customer while underwriting process, even in the pre-pandemic stage, has helped us. And the way we look at the business model of the customer post availing the equipment has actually led us believe that our underwriting process is actually working in this pandemic scenario. And there would be many more NBFCs who would have these unique underwriting processes, which will immediately fuel economic growth or will fuel growth once they see green shoots in their individual segment. And again, any generalization for this will be very harmful for the segment. So if you say that one category of NBFC is reviving, that means everybody will revive, or one category of NBFC is not reviving, that means nobody will revive. I think this far-fetched generalization is not going to help the industry.
So, which are those kind of? Can you give us some example of like which are the kind of equipments you're talking about? Something different, not. I'm sure tractors will be there, or those are like known things, but something you feel that perhaps the audience does not know. And what kind of ticket size of these?
So today people are doing right from like two-wheelers, but it could be used two-wheelers, right from 25, 30, 40,000 rupees, two-wheeler, four-wheelers, cars. It could be farming equipment, tractors. It could be machineries, your machinery equipment into auto ancillary. Now, because of the geopolitical situation that we are into, the demand for machinery, indigenous machinery or machinery from European and American brands have gone up so tremendously in the industrial tooling segment, auto ancillary, pharmaceuticals. The demand from the manufacturing side has gone up so much that for those kind of machinery. You can get into agri now. Rural economy today is really doing well. I think in September, August, the data that is coming out from RBI government, the rural economy has really done well. So again, two-wheelers, farm equipment, specialized farming. Now people are getting into dairy, cold storage. So there's a large amount of large segment that people can be specialized in. And now you have different types of NBFCs within that. So you will have four-wheeler NBFCs, two-wheeler NBFCs. Nowadays, there are NBFCs which only do education loans. They don't do anything else, but they do not only student loans, but school loans. So they give loans to schools. You have agri NBFCs that finance the entire agri value chain, right from a farmer to an FPO to a processing unit. So then you have MFIs. So there are a lot of specialized categories of NBFCs which have come up, who have mapped their markets, mapped their segments. You have a blue collar financing NBFCs now, people who finance blue collar employees for their, typically their salary gets over by 24th or 25th of every month, and they need those 5 or 6 days of working capital before the next salary gets credited by 30th. So you've got NBFCs which are financing blue collar workers now for those 6-7 days. So these are very specialized NBFCs which have come up. And I think these are very great opportunities in different pockets and segments.
Yeah, so the last one is more of a B2C kind of stuff.
Yeah, it's
so what are the new market segments which NBFCs can explore? I mean, you did say from an equipment point of view, but are there any new segments that you see NBFCs are exploring? Because there is no more boundaries for NBFCs and banks and other institutions. So the boundaries are all blurry. Do you see any new segments NBFCs explore?
So, a lot of people want to go beyond loan as a product, right? So, we are getting a lot of inquiries as to how someone can get into leasing. What is leasing? A lot of people are coming to us and saying our customers are saying we don't want loans, we want leasing. So there is leasing as a product which is picking up very fast, and GST has been a biggest contributor in promoting leasing. I think in the VAT and the service tax regime were not very friendly, but the GST regime has been very friendly with leasing. So there's been a lot of inquiries and a lot of interest in leasing as a product. There's a lot of interest in bill discounting now. So there are hardly any bill discounting companies, or there are hardly any very few NBFCs that do a non-rated, non-investment grade bill discounting. So there's a lot of demand coming up for SME bill discounting NBFCs, bill, invoices raised on non-investment grade entities. Can it be discounted? Uh, and then there are other, in the B2B segment, there are working capital products which are coming up. Card-based financing is coming up, a B2B card-based finance. So there are companies in fintechs which are coming up with card-based financing in the B2B segment. So people are trying to identify niches and trying to see whether they can fill up the gap in that. So for example, a lot of healthcare financing in India happens in the radiology segment, in MRI, CT, oncology, which is cancer. Now all these starts at 2 crore, 3 crore, 4 and above. Like an oncology, a linear accelerator in cancer treatment starts at 6.5 crores. However, we kind of pioneered a small ticket size healthcare leasing. So our average ticket size in healthcare is 15 lakhs, 20 lakhs. So we started from a single dialysis machine of 6 lakhs because we saw that there's a huge demand for dialysis machines in this country. But that was not considered to be an equipment by a lot of people. So we started specializing in certain category of nephrology. So these are the pockets where every NBFC would want to identify and create their niche.
Very true. Thank you. That's nice. Good to hear those new things that you're doing, Shrirang. Ladies and gentlemen, I hope you are enjoying this discussion on NBFCs. And really, there are so many new things that are coming about, and Shrirang has been able to dispel the financial inclusion, which has always been a B2C kind of industry. He has stepped into a B2B financial inclusion. Uh, of course, these boundaries of what is B2B, B2C are all blurry. So, but nevertheless, it's a great concept that he has. I'm sure you have a lot of questions to ask him. So you could ask him those kind of questions either through the Q&A chat box, or you could, if you wish to ask a question directly to him, you could do that also by just raise your hand, and the digital team will uh, enable you to kind of ask the question directly to him. So we await your questions, and meanwhile I will get on with my discussion with Shrirang. Shrirang, the fintech segment has seen a meteoric rise over the last 5 years, correct? I mean, so much has happened. Fintech was never heard about 5 years ago, but then it's been fintech has seen collaborations across, right? The banks are embracing them. The retail big companies are embracing them. So recently, in a few fintechs who have been granted lending licenses have announced their intent to enter a co-lending arrangement with NBFCs. And there are also, I mean, examples. I'm not giving any names, but they're out there, as you know. Can you tell us how fintechs are enabling NBFCs to reinvent their functional capabilities and revamp its customer outreach strategies?
In the post-pandemic scenario, I think the technology is definitely going to play a very big role across all functions of an NBFC, right from even a lead generation to credit to collection. There was scenario where I mean a lot of NBFCs would have definitely witnessed this in the last couple of months, especially in the lockdown period, that your own customer even could not visit their own factory. I mean, we had cases where our own customer could not visit their own factory. So forget your people visiting your customer. Or if you want to go even for collection, how do you go if it's a containment zone, right?
Yeah.
So this has led to a paradigm shift in how people are thinking about technology in this business. There are certain businesses where technology has to be paramount. It can't be just an enabler. It's a cornerstone or a pillar on which the entire business comes up. And there are certain businesses where technology is only an enabler or a supporting function, where it helps you, where it just helps you. What this pandemic has done is that it has actually made technology move up the value chain just from being an enabler to being one, the core functions for your entire lending activity. Now, within that fintech, there are two types of core fintechs, or three types of fintechs that you would broadly see. So there are one set of fintechs which have nothing to do with lending. So they are more into payments and other value-added services. They are now morphing into something what people are now calling neobanks, and that's a different concept altogether. But these are not traditional lending where they are borrowing at capital and disbursing the capital. Right? The other set of fintechs which are into lending business, but they're using technology extremely well to channelize this capital to the end borrower. Right? They are channelizing this capital, and the entire process is technology driven. And there's a third set of fintechs which are only marketplaces, which means that they are intermediaries or connectors between the capital providers and capital seekers. And these intermediaries or these marketplaces have on the value chain, they would go right from acquiring a customer for you to even sometimes doing a limited credit on your behalf. They may even do the entire disbursement process for you, or they could just be a lead generator for you. But these are marketplaces. They do not lend on their own. They do not have a balance sheet or a liability on their own. They are playing on an arbitrage that the lender, an NBFC or a bank, does not have an access to the last mile, or does not know a person there, or does not know that a person exists, and that person wants a credit. So these are the three types of fintechs which have come up now. And it is very important to understand that what they do is that they need to keep evolving in their technology so that a superior customer experience is given. Plus, there are many people who are marketplaces, then have applied for a lending license. They want to now combine the marketplace with the lending. There are a couple of lending companies which want to now grow the marketplace model. So again, in that also there will be hybrids. There would be hybrids, and there would be the lines would start getting blurred. But the entire genesis between all these groups is they are using technology as significantly. It's in the forefront across the entire customer experience and the value chain delivery. And it is not just an enabler, it's one of the core processes that they are deploying. Uh, uh, and then the last category is the supporting fintechs. When you say supporting fintechs, there are fintechs who will pull out data for you. They will analyze the bank statements for you. They will give you a lot of APIs so that you can run your credit score properly. So that's a service model of fintechs, where these
Yeah.
are service providers that are providing their service to the lenders or the marketplaces so that everybody does not need to reinvent the wheel. So the smart ploy in a fintech play is you do not go out like and have a bravado and say I will build everything, right?
Yeah.
I think the smartest thing to do there is try and identify what is your workflow, what is your process, and who is doing that now, and do a plug and play so that your time to market, your go to market, your time to execution is reduced. And you have a through APIs you have a huge leeway today, or a huge leverage today, where you can actually integrate a lot of service providers and get your work done. So this is where I think fintechs play a very critical role, and it will keep evolving. Like you mentioned today's policy, right? Now there are two big changes that have happened in today's policy. First, the RBI has said that in the co-lending model, right? In the co-lending model, it can be all NBFCs, including housing finance companies, whereas the earlier regulation said only systemically important NBFCs, which means 500 crore and plus. So
Yeah.
now the co-lending has come to any size of NBFC. So even if you are a 100 crore NBFC or below or above, less than 500 crore, you can actually partner for co-lending. And how will you do that? You would be able to only do that if if you have a reach in the nook and corner of this country through technology. I mean, you cannot expect a smaller NBFC to have 150 branches in 150 locations.
Yeah.
Uh, so what are you going to do? You're going to tie up with somebody who says, I will give you a file in 24 hours. I'll give you a decision in 2 days. I'll give you a customer in 1 day. So you need to have technology in that.
True. So that's going to be a game changer, because you feel so, because a lot more companies will find that the level playing field is the same. I mean, that's what I think the government is trying to get, a level playing field for all NBFCs in the co-lending space.
Yeah, they're actually realizing, that NBFCs play a very big role. So
Yeah.
the data shows that 70% of the first credit to any person, I mean, overall, 70% of first credits in this country is given by NBFC, not banks. Which means that out of 100 people who do not have access to loans or credit, 70 people get it first from an NBFC and not from a bank, right? So I think there is definitely a realization that you NBFCs have a far greater reach, a far greater access, a far better agility and flexibility to to transfer the credit to the needy. And that is where the financial inclusion aspect comes into play. So there's no doubt that NBFCs are going to be the drivers of financial inclusion in this country. If you want every person in this country to have credit, there's you can call it fintechs, you can call it NBFCs, you can call them marketplaces, but at the end of the day, it has to be it will be an NBFC which will lead to that last mile credit to the borrower.
Absolutely. Okay. Very interesting, Shrirang. Extremely interesting, I would say. Uh, so, like I said, audience who come into this show, not only through the EPS channel, but also they come through Facebook, Twitter, YouTube, and LinkedIn too. So they could ask you questions, and we also have so they could ask a question in the chat box, or they could ask you a question directly. So we have the first question that comes to you directly from a very, very experienced banker, Harish Prabhu. He would ask you a question. Harish, would you unmute and ask the question?
Yeah, good evening, Shrirang. Good to know that you are a speaker here.
Yeah,
So,
good to connect, Harish.
yeah, hi. So, I've been covering the leasing industry as well as NBFCs, on the loaning side. But what is the single biggest reason that the lease finance industry, especially, lease finance NBFCs, right? Apart from, let's say, ILFS and all, which were the, infrastructure leasing companies, etc. They have not grown as compared to the proliferation of a large part of loaning NBFCs, right? Including microfinance or what have you across the chain. So is it because of the complexity or lack of awareness of the leasing product versus a loan product, or is it because of the tax inefficiency to take a lease versus a loan, or what is it that is not really, taken the lease product, into, nook and corners? The reason why I ask this question is if you go to see US, Europe, leasing as a product is quite ubiquitous and it funds a large part of, the what you call credit needs of industry or small to medium industries also.
Yeah. So Harish, there were multiple factors. So if you see India in late 90s, early 90s, there were around 200 plus leasing companies in this country. But there was a retrospective tax that was brought, and everybody was asked to pay VAT on all the retrospective leasing transactions in 2003, when the VAT was introduced. And this introduction of VAT literally killed the industry. The second issue, obviously, is the one that you highlighted, and because of which what happened is that as a product kind of phased out from the market, the awareness was zero. So today, if you get 50 MSME promoters in the room, 47 of who would tell you that they had never heard of leasing before, or they had only heard it for car leasing and not beyond car leasing. So the industry has to grow. A large number of players have to come in. However, it's a great product. It's a product which has the benefits with respect to the ability to understand a business. It's the only product which basically meets the textbook definition of cash flow backed financing. Now, so all recently RBI, earlier governors, even SBI, etc., have all been talking about cash flow backed financing and not asset backed or collateral backed financing. So leasing is a textbook product for this cash flow backed financing, where you try to estimate an ability of an incremental equipment or an asset, whichever asset that is, the earning capability of that asset, and whether that earning capability would pay the lease rentals. So, and the second point is it can go to any size of the company. You don't need a particular size of a company to do leasing. So there have to be more players coming into it, and I'm happy to say that there's a lot of interest domestically and internationally where people want to step into this country. I think that speed has to accelerate, and the awareness has to be created. I truly believe that it can go the MFI way. However, MFI caught it very fast, and I think one of the reasons for that is availability of large amount of financing in this country for that product. If we can actually put leasing into the same bucket of lending under all the regulations, then the priority sector lending and all other benefits that a standard loan gets would also be availed by leasing, and by sheer infusion of large amount of capital from the banking system, the product will be able to grow. So I think these are the 2-3 factors because of which it's right time for the product to catch up. There's one more hand which has gone up.
Yeah. so that anyway, thanks Harish. Harish, once again, an excellent question. Harish has been our regular or participant and asked excellent question. Thank you once again, Harish. Another question has come from Srinivas Kanteti. Srinivas, can you unmute yourself and
Yeah, so can you hear me?
Yeah, Srinivas, hi.
Yeah, hi Shrirang. Nice to see you here. So my question is on leasing again. I think partly covered by Harish in some way, but as you know, we are into actually a B2C kind of a business, a two-wheeler business, financing two-wheelers. So I have always wondered that why leasing is not getting caught in a big way in this country for a B2C kind of a situation. I mean, B2B, at least, we are seeing now people showing interest in leasing, etc. But B2C somewhere, leasing is still at a very, very infancy, both in terms of supply and demand. What is your, what is your take on this, basically?
So one of the reasons, Srini, I think is the earlier generations. I mean, I think one of the reasons is also demographic profiling. The earlier generations always wanted to use an equipment till it's really dead, right? Whether it's a car or a fridge or anybody. Whereas the current generation that you would see, the more Uberization or the Airbnb experienced generation, they would want a new model even if their older model is still working. They would want to change a phone even if there's nothing wrong with the phone. So in this kind of a scenario, leasing works very well. But if in a B2C mindset, if you have a larger population saying that I will only change my equipment only after it stops working, then leasing does not have will be difficult to catch. But if somebody says that I would want to change the equipment as soon as a new model or a new technology is there and I have a better convenience, leasing will immediately pick up, because the underlying and the fundamental value proposition of leasing that has been offered globally has been technology change, has been new models, has been recycling of technology. So and that you see in cars, right? Why has car leasing or why has ORIGA become very large in India or globally? Is because people buy cars, and then they say, okay, my Vento is doing well, but I don't mind going for Skoda. My 325 BMW is doing well, but I don't mind the 525 BMW. So when that comes in, where you're moving towards different brands, or you're moving towards more product range, or you're moving towards better technology, then leasing will automatically pick up. But if a larger population has a mindset saying that I will use it till it is dead, it will be difficult for leasing to pick up.
okay?
Thank you.
Thank you.
So I think,
thank you, Srinivas.
So I think people who sell leasing have to show this benefit.
Yeah.
They have to sell this benefit, saying that there is a better model that has come up. Why are you using this model? It will give you this efficiency, that efficiency. So I think it's a lot of selling concept of a new technology.
Okay.
Thanks a lot, Shrirang.
So one of the problems we all know was the fund flow and credit worthiness of NBFCs. For whatever reasons it has happened. So according to you, Shrirang, what should be done to ensure flow of funds to credit-worthy NBFCs, especially the small and medium-sized ones, and to minimize the systemic risks?
So this is a very large topic. I'm a part of the community and we keep discussing this all the time.
Okay.
But I think there are a lot of suggestions been floating around in the industry. But one thing that has to slightly change is the credit appraisal of the NBFCs themselves, both by the banks and by the rating agencies, both, right?
Yeah.
So both have to understand what this peculiar NBFC is all about. And again, so the way we talk about our MSMEs, small NBFCs are actually MSMEs of the financial segment. If you look at it from the other side, all the small NBFCs are so-called MSMEs of the financial services segment. So you need specialized credit tools, specialized risk management and risk assessment for smaller NBFCs. I'll give you an example. I mean, if people will be, everybody who are from the industry would know the funnel. I mean, there are 12,000 odd NBFCs registered with RBI, but out of that, maybe only 900 odd are systemic, or maybe 200 or 290 odd are systemically important, which means 500 crore and above, and only 890 or 900 are 100 crore and above, right? So out of 10,000 NBFCs that you are having 800 and 900 NBFCs which are above 100 crore or 500 crore. That means you need specialized risk assessment and credit assessment tools, both at the financial level and at the credit rating level, to really open the large pool of tap for smaller NBFCs. And you cannot look at them with the same lens that you would look at a 30,000 crore NBFC or a 10,000 crore NBFC, or I'm sure people do look at it differently, but I'm saying there has to be more granular approach to understanding the business model of an NBFC. And plus the debt paper, the bond market, opening of the bond market, opening of the junk bond market. See, the biggest challenge today is how do you resolve your NPAs? And that is even the banking segment, right? I mean, everybody is talking about bad bank and everything, and IBC, and I mean, we've been trying to bring host of regulations to in the banking segment also. One of the ideas which have been in discussion at many forums, associations, with the government, with the regulators, is developing the junk bond market. Because as soon as you develop a junk bond market, you are able to sell your NPAs and underlying NPAs as a paper to the investors, then you have a very vibrant junk bond market, and that frees up your liquidity, that frees up your capital very fast, and you have a lot of investors investing. So one of the initiatives that I personally feel as a country we should look into is developing the junk bond market and the junk bond paper very, very quickly.
Okay. So I have a question, a very interesting question on the same lines from Mr. Pushpendra Khandelwal. He says, during this pandemic period, banks are facing the problems of recovery of loans that is recognized even by the court because of the pandemic that we have. Their balance sheets are under stress. In such situation, how do you think that NBFCs can win this battle? And what is your vision for the future of NBFCs in this matter?
I think what we discussed over the last 45 minutes really sums up the reply for this, because the battle could be won only when you know and you are able to assess your credit risk properly. And we discuss all the ways by which the last touch point that NBFC has, makes them do that, right? But, so definitely that's a big plus. The only point of concern here is how much and how often and how large will the bank lending be to the NBFCs, right? The smaller ones, the medium ones, the lowerly rated ones, etc. And I think in that way, the finance ministry and RBI have done a phenomenal job in terms of policy announcement over the last couple of months. Even where the unrated NBFCs were also given a window to access capital, etc. Even today, for example, there is another policy decision that was announced, whereas in the TLTRO, the window or the other windows, initially the bank could only buy bonds issued by the NBFCs. Now RBI is saying you can even give it as a term loan. So that's a big change, because smaller NBFCs have no way that they can issue bonds, right? So the window that you have opened for a larger pool of capital for the banks to subscribe to the bonds of smaller NBFCs is not possible, because smaller NBFCs don't go to the capital markets to issue bonds. But today, there's an announcement that that capital that you get from that window can also be used for term loans. So to give term loans to NBFCs, so that's a big shift in channelizing credit to the smaller NBFCs. So I think, and there's one more question before that also, I think that's been there for quite some time, on the score of
1 to 10. Could you rate the maturity of the true residual risk-based pricing models in Indian leasing business?
I think it's at around, it's very segment to segment, so it can't be generalized. So if you look at cars and automobiles, then it will be as high as 8 or 9. If you look at construction equipment and infrastructure equipment, again it will be quite, it will be slightly high, because there's been a history of leasing of construction equipment, cranes, and all the and there is a big infrastructure push, so you will need this equipment. But if you go to some exotic equipment, if you go to equipment which have not been leased before, then the scale will be, the understanding of the residual risk value will be very different. So there is no cookie cutter answer to this. It will be very segment to segment based on the class or the nature of the industry that the leasing is pertaining to.
Okay. Talking about the earlier questions on the battle of collections, what's been your company's battle in terms of the collection during this because of this pandemic?
So collection was definitely a battle, and we had to have a lot of follow-ups. But there was one area where we scored, and we believe we scored well, was again the kind of equipment and the machinery that we leased. We typically lease only core bread and butter machinery, something which is highly cash generating and which is absolutely core to your business, core to your organization. We don't do anything which is good to have. So which meant that any entrepreneur or an enterprise had to sweat it out for themselves, because they also had to earn their bread and butter from their factories and whatever commercial activity that they do, right? So I think in a B2B financing, this is one of the areas that we have learned where you need to focus on the core cash generating activity of the enterprise. And if you are able to finance that, then your ability to recover is slightly higher. Obviously, there can be an intent issue and all that, so that's a different matter. But from a business point of view, something which is really core and bread and butter for these enterprises would be something which will have a high propensity or a probability to pay compared to something which they can do without. They can do without. So that is something which is a very interesting factor in a B2B segment.
Okay. Just want to thank Pushpinder and the anonymous attendee who asked this question. Another question is coming to you from Harish. He says, what about tax efficiency of the lease product?
So typically leasing, and especially operating lease, there are two types of leases: finance lease and operating lease. But typically operating lease globally has been used as a tax planning tool. So a lot of companies globally, even if they have cash on the balance sheet, they lease for tax purpose. Let's take a case of MNCs leasing cars in India, or large corporates leasing cars in India, etc. A lot of that goes as a tax benefit either to the employee who's leasing a car or the corporate which is leasing the car. So leasing definitely has a very higher tax benefit. Just to give you a very high level back of the envelope example, a 1 crore lease for 3 years in the loan product will give you a tax benefit of broadly 17 lakhs, whereas in leasing would give you a tax benefit of 34 to 35 lakhs, which is almost 2x. So people who are very, very tax conscious, and I think everybody is, including Google, who makes billions, but they have a lot of entities in the tax havens, right? So everybody is tax conscious. So it's a great tax planning tool. But more than that, it's also a great product where it can keep your balance sheet very asset light, and your ability to attract working capital and other forms of financing because of ratio improvement is very high. So it has many benefits which helps you as an MSME or as a factory owner or as a anybody else to actually earn, have better finance raising capabilities apart from leasing. Look at Ola, right? As soon as Ola realized that uh, drivers are growing, Ola started Ola Leasing. They bought
Yeah.
cars and they started leasing to the drivers. Now, it could have been very easy for Ola to go to Axis Bank or ICICI Bank and HDFC Bank and say, I will refer you the drivers, you pay me a commission, but you give them car loans. But Ola didn't do that. Ola set up their own leasing company to lease cars. So the product has
Yeah.
a lot of inherent benefits. Otherwise, it would have been so easy for them to, their syndication income would have been in crores, looking at all the drivers who have got the cars, right?
Yeah. Absolutely. Thank you. DJ Gupta has asked you a question. Why RBI asks banks to fund NBFC term loan or bonds, etc.? Why not RBI take direct exposure on NBFCs and taste NPAs? Good one.
I'm not a regulatory expert, but
Yeah.
no regulator would do that. They would always have an intermediary in between who understands, who has the ability to do the credit risk and has
Yeah.
an ability to look at the business models, etc. RBI has their own set of functions cut out. So credit appraisal is something that they would not definitely get into. It's a central bank. So, but they can also, not only banks, I think the way to look at this is they can look at a lot of other nodal agencies like SIDBI, NABARD, or many other such agencies to increase the capital flow, which they have already done. It's just that the execution of that has to be, in a time-bound manner from the nodal agencies. But I think a lot of steps have been taken in the positive direction to route the capital from the nodal agencies. Like for example, the CGT SME scheme, which is the central government guarantee scheme. For many years, the limit was 1 crore, which was a
Yeah.
collateral-free loans to small enterprises. That limit has now been increased to 2 crores over a lifetime. So, and that is collateral free. So typically the way it works is bank takes certain percentage of the risk and central government takes it. But central government means central government typically does not take the risk. It's the SIDBI or some nodal agency that takes the credit risk, right? So there has to be a larger intermediary in between that acts on behalf of the government or the regulator.
Okay. Thanks, DJ Gupta. Anonymous question means an anonymous attendee. Leasing were also seem to be a way of not showing leverage on the company's books. As per the proposed accounting rules, I am told this to be shown as notional asset and liability, which defeats the purpose. I understand it might even impact house leases for more than 2 years. You are aware of this, Shrirang, and you could answer this?
So there's a new IFRS 116 which has come up globally, and
Okay.
that has come up because of Enron. So Enron scandal happened. The entire Enron blow up happened because all the liabilities were hidden as a lease, basically, and they were not on the balance sheet. They were in the SPVs. So after Enron, the entire accounting standard boards came together and they decided that all these liabilities have to be shown on the balance sheet. But today, because we are running out of time, I will just like to mention that today these are only for large corporates, MNCs, etc. Currently, these are not there. These are not applicable to companies which have net worth less than 250 crores in India. And plus, they are applicable only to private limited companies, not to partnerships, LLPs, proprietorships, etc. So still there's a long way to go for that accounting standard implementation to come for small and medium segment. Currently, the people who have to follow that are subsidiaries of MNCs or companies which have a net worth of 250 crore plus.
Okay. Thank you, Anonymous. So can we take a couple of more minutes of yours?
Yeah, I'm okay.
Okay. So are NBFCs exploring alternative borrowing channels to address the ALM mismatch, asset liability mismatch, and reduce overall cost of funds?
That's the ask from all the NBFCs, right? So how do we look at creating long-term funding
Yeah.
from, say, again, SIDBI or other nodal agencies for this ALM mismatch? Look at CPs, right? CPs are 1 year CPs, revolve commercial papers. If so, there has to be a matching, and I think a long term, you need a fund, you need some kind of a debt fund or AIF or whatever legal structure, but you need something which has a 7, 8, 10-year funding horizon as a refinancing mechanism for NBFC. So, but it can't be done at an industry player level. It has to be done at a regulatory level, or it has to be done at a policy level. It is not that 10 big NBFCs come up and set up their own fund to fund each other. That is something which will not be sustainable. It has to be at a policy level where larger pool of capital is raised and deployed.
Okay. Shrirang, how can NBFCs optimize the operational cost to improve the return on equity and free up capital for investments in growth areas?
So there are two costs which come and hit NBFCs very, very badly, right? The sourcing and distribution cost, and the collection costs. Apart from the interest cost, leasing has even a depreciation cost. So leasing has one more layer of high cost, which is depreciation, but which is non-cash. So can you leverage technology? So the funny part that I find in this discussion is, when you look at acquiring a customer, you talk about technology, but when you look at collections, you always talk about branch banking, because people say that you cannot collect without a branch. So today the industry is facing this question, that should we go digital, or should we go back to branch banking, right? Because branch banking, to sell a loan, is very expensive, but can you collect digitally? Will you be able to address your NPS digitally? So I think this is a very tricky question to answer. And where do the costs lie? Do the costs lie in distribution and customer acquisition, or does your cost lie in collection? So every NBFC need to identify these elephants in the room and try and address them, because it won't be same for everybody. It will be different for some people. Will have, like I know fintechs who are paying through their nose to acquire a customer. A retail, I mean, they are paying more than 3.5% to DSAs to just get one customer, right? So where are you going to make money from if you're going to pay 3.5% to your DSA to get a customer, right? And then you have, it's good to say that I will lend into interiors, and I will lend into far flung places. And then how are you going to collect it? Is that collection cost going to be 5% or 4% or 3% of your? Then where are you going to make money, right? So every NBFC has to look at three costs clearly. One is the customer acquisition cost, the distribution cost, and the collection cost. And I think these are the three areas where most of the NBFCs have massive cost structures, and they have to figure out what is the model that works for them.
Okay, let's take a last question, Shrirang. Question comes to you from Krishna Tripathi. He's from the media, ETV Global. What's your first reaction on RBI's decision to keep rates unchanged? Is RBI trying to keep inflation under check? Your views?
I think my first reaction to that is they are expecting that things have normalized to a large extent, and they don't need to have a knee-jerk decision or a reaction. They may want to monitor it for another 1 quarter, and that's my first gut reaction, without much analysis, much scientific approach. So when you don't change the status quo, many a times you are expecting some things that have calmed down or things have settled down. So that could be the immediate reaction, saying that now we don't need to really have any knee-jerk reaction still, because we are seeing some better days ahead.
Yeah, I think it is more accommodative, the entire today's decisions from the RBI. So Shrirang, thank you very much. Krishna Tripathi, thank you very much for this question. I hope you got the answers. Shrirang, we come to the end of our discussion. And it has been wonderful talking to you on NBFCs. Ladies and gentlemen, I hope you enjoyed the discussion with Shrirang on NBFC. And some of the things that he said was, 75% of the first credit comes from NBFCs, not banks. So that's the kind of importance NBFCs have in India. Okay, 75% of the first credit for a customer comes from NBFCs. And the NBFCs, as you've seen, have demonstrated a lot of ability, agility, flexibility, and the NBFCs have been the players in the last mile. Okay, they have gone the remotest possible places of India and have tried to bring people into the mainstream of financial services. So their work, their task has been tremendous. And with that, I would request you to join me in thanking Shrirang to come over, talk to us on the challenges that NBFCs are facing and how they look forward in the days to come. Shrirang, thank you very much for coming.
Thank you. Thanks, KK. Thanks to EPS. Thanks to everyone who invited me here. And thank you. Look forward to meeting you again.
Yes, look forward to meeting you again. Thank you very much, everyone. Goodbye and have a nice evening.
Goodbye.